Hello, and welcome to Explain the Charts, your channel for in-depth technical and fundamental analysis. Today is November 21st, 2025, and we are taking a close look at Meta Platforms, symbol Meta, which has been experiencing extreme volatility and a significant sell-off recently. We'll cover the crucial news driving the sentiment and then dive into the daily, hourly, and 15-minute charts to see what the price action is telling us. First, let's talk about the news, because the narrative around Meta has soured considerably. Multiple reports highlight that the stock has dropped over 20% since its late October earnings report. The primary driver for this bearish sentiment is Meta's rapidly growing capital expenditure, which is now projected to be between $70 and $72 billion for 2025. This massive spending is fueling fears that Meta's AI cycle could be a repeat of the costly and, so far, profitable metaverse overbuild from a few years ago. Unlike competitors such as Microsoft or Google who can monetize AI through their cloud platforms, analysts are concerned that AI is primarily an incremental cost for Meta without a clear path to direct revenue generation. This has led Wall Street to scrutinize every dollar of AI spending. Investors Business Daily noted that Cantor Fitzgerald cut its price target on Meta from $830 down to $720, citing rising cloud capacity costs. They specifically pointed to a massive quarter-over-quarter increase in contractual commitments, a large portion of which is for third-party cloud deals. Furthermore, MarketWatch reported on a significant leadership shakeup, with Meta's chief revenue officer departing. This move is seen as an attempt to address Wall Street's impatience regarding returns on the company's huge AI investments. The technical ratings reflect this bearishness, with an accumulation/distribution rating of E, suggesting heavy institutional selling. On the positive side, Meta continues to show strong user engagement, with time spent on Facebook and Threads growing significantly. Real's annual run rate has surpassed $50 billion, and its AI-powered ad tools are also showing a strong run rate exceeding $60 billion. However, the market is currently laser-focused on the costs and the potential for negative impacts on earnings per share. The Q3 earnings report itself was a catalyst for the drop, with a reported EPS miss partly due to a massive $15.9 billion tax charge. Now let's see how this news translates to the price action on our daily chart. Looking at the bigger picture, Meta had a powerful run-up for most of 2025, peaking here on August 15th at an all-time high of $796.25. Since that peak, the stock has been in a clear downtrend, establishing a pattern of lower highs and lower lows. This multi-month sell-off shows a significant reversal from the previous bullish momentum. The price broke below several key support areas on its way down, indicating sustained selling pressure. The key question now is whether this is a healthy correction or the start of a more prolonged bear market for the stock. Let's zoom in on the most dramatic part of this chart, which happened in late October. Here we can see the price was consolidating around the $750 level just before its Q3 earnings announcement. Then on October 30th, we see this massive gap down, with the stock plunging from a close of $751 all the way down to open at $669. This nearly 11% overnight drop created a huge resistance zone, known as a breakaway gap, which is a very bearish signal. This move was a direct reaction to the earnings miss and the guidance on increased AI spending that we just discussed. The volume on this drop was absolutely enormous, confirming the conviction of the sellers. Following the initial gap, the selling continued for several more days, pushing the price below $650. This price action clearly shows that the market was shocked by the spending plans and punished the stock accordingly. Bringing our view back to the full daily chart, we can see that for the past 3 weeks, the price has been attempting to find a floor. We have established a key short-term support level right around the $581 to $583 area, which was tested just 2 days ago. A definitive break below this level on high volume would be very bearish and could open the door to a move down towards the $550 psychological level. To the upside, Immediate resistance is found at the recent consolidation highs around $610 and then a more significant level near $635. However, the ultimate resistance for any major bullish reversal is the bottom of that earnings gap, right around $670 to $680. It would take a tremendous amount of buying pressure and a significant shift in the fundamental narrative to fill that gap. The stock is currently trading below all major moving averages, which is another sign of technical weakness. The year-to-date gains have been almost completely wiped out, putting the stock at a critical juncture. We are essentially in a battle between sellers who are worried about costs and buyers who believe in the long-term AI and engagement story. Now, let's switch to the 15-minute chart to analyze the very recent price action from this week. As we can see, the week started with the price trading around $612 on November 17th. From there, we've seen a steady grind downwards, culminating in the test of support below $584 on November 20th. Yesterday's session showed a sharp sell-off in the afternoon, followed by an attempt to rally back. This intraday volatility highlights the ongoing indecision in the market. The price is currently hovering around the $590 mark, trying to reclaim it as support. A failure to hold this level today could see us retesting yesterday's lows very quickly. The short-term trend is clearly bearish, making it difficult for bulls to gain any traction. We need to watch for a break of this downward channel for any sign of a short-term reversal. The key intraday support to watch today is that low from November 20th around $583.35, while resistance sits at yesterday's high near $606. So, let's synthesize all this information and discuss what we should be looking for. The bearish case is currently very strong, supported by both the fundamental news and the technical picture. Concerns over massive AI spending, lack of a clear monetization strategy, and heavy institutional selling have created a powerful downtrend. A break of the critical $580 support level on the daily chart would likely confirm the next leg down, with a potential target of $550. This scenario becomes more likely if we see continued negative analyst commentary or broader market weakness. The bullish case, while being a contrarian view right now, hinges on this $580 level holding as a firm support. If buyers can step in and defend this zone, we could see a relief rally or a period of basing. For bulls to gain control, they would need to push the price back above the $610 level and then challenge the more significant $635 resistance. A catalyst for this could be positive news from the company clarifying its AI strategy or a surprise announcement that boosts investor confidence. Long-term, the growth in user engagement is a powerful asset, but for now, the market is pricing in the high costs. The probability of further downside seems higher in the short term, perhaps a 65% chance we test lower levels before finding a true bottom. A rally back above $635 would invalidate this bearish outlook. To quickly recap, here are the most important price levels to keep on your radar. Major, long-term resistance is the gap fill area between $670 and $740. Near-term resistance levels are at $610 and more significantly at $635. On the downside, the critical support zone to watch is $580 to $583. A break below that puts the psychological support at $550 squarely in play. Keep an eye on trading volume. An increase in volume on a break of these levels will give it more significance. Also, watch for any new company announcements or analyst rating changes, as they could serve as powerful catalysts. Thank you for watching this analysis on Meta stock here on Explain the Charts. Please remember, this video is for informational and educational purposes only and should not be considered financial advice. Always conduct your own research and consult with a professional before making any investment decisions.